Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are talking about, give my financial opinions alongside it. And again, if you want to follow me, you can follow me at finding_finance, or you can follow me at the website, finding-value.com. Become a platinum member, use the word discount in the coupon code. We do have a 5 p.m. Mountain Standard Time Sunday session. I know it's on Easter. I didn't even realize that, but we'll continue to do it, and I'll tape it, and you guys can watch it if you can't make it. So coming down here, it says, Aaron says, since I graduated high school in 1996, gold has gone up 482%, the S&P 500, 418%. Now, here's the tough part, guys. If you can't beat gold, or if you're struggling to beat gold, then why not just buy gold? Gold is just a lump of metal that appreciates with currency circulating in the system. The S&P 500 has not beaten gold, and if the majority of people can't beat the S&P 500, well then almost everyone has not beaten gold. Gold is out of the system. It carries less risk, in my opinion, than the S&P 500 does, and gold is actually priced very cheaply against the S&P 500. It's priced very cheap against a bunch of different assets. It's priced cheap against the M2 money supply. Gold has not even accounted for the majority of the money in the system. And if S&P 500 still can't beat it, even during its first revaluation move, I don't even want to know what comes the next 10 years. And that's how I invest. I take 5 to 10 year outlook and say, look, what's going to do well? What's going to do well with the least amount of risk? Gold is one of those things. Same with platinum, same with silver, that could do incredible things over the next 5 to 10 years. I think it's going to beat the S&P 500. I think it's going to beat housing. I think it's probably going to beat most everything, especially on a risk-adjusted return, because the risk is so low. But that's my take on it. And I do like the other metals too, silver and platinum. Even palladium. I'd rather have palladium over S&P. Palladium smoked the S&P 500 over this same time frame. Welcome to the energy cliff. With the global oil industry suffering from 10 million barrel per day natural annual decline rate, it doesn't take a brain surgeon to figure out the world is in serious trouble. Got your gold and silver. And what's going on here is existing oil that is being produced has a natural decline rate of 10 million barrels per day. That means that we need to find a new Saudi Arabia every single year to stay flat in oil production. And I don't even think we can do that. It's going to get real difficult here to keep production flat. Demand is increasing dramatically. And if supply cannot increase, that just means people are going to be fighting over oil through rising prices. We're going to be outbidding each other for the oil that is out there. And the reason that gold and silver and a lot of these metals are so good, gold and silver is more or less just a derivative of energy. All commodities are a derivative of energy. All products are a derivative of energy to some extent. So all we do is we yank commodities out of the ground using energy, and that's where it's a derivative of energy. And then we refine it. We use chemicals and all this other stuff to extract it out. And that is all energy intensive. So if you have a problem with energy, what it's going to do is it's going to cause everything to increase in cost. And it will also threaten the currencies in the system. The energy cliff and energy in itself backs the currencies. It's future earnings of companies, and it's the energy that backs those future earnings. If people figure out that the energy is going to have a problem, then that means that the future earnings of companies are also going to have problems. Which means that since bonds and currency are future claim checks to future production or future commodities. And if energy is short, people are going to question the currency itself. And that's where you go into a gold and silver type scenario where you don't have counterparty risk and where the dollars could become worth a lot less. David Brady says, I'm not saying this is a certainty, but I am saying the ideal conditions are in place for the bullion banks to push prices lower should they choose to do so. I plan to buy the dip in gold for the test of the record high at 2089. Next, and 30 in silver to follow. So David Brady might think that they're going to get a little bit of a pullback, perhaps, maybe. It says the Fed's tightening cycle is basically done. Once the Fed pauses after a tightening cycle, it is bullish for markets, including gold and silver. That's what happened of the last cycle of 2018, 2019, and then 2020 capitulation bottom of March. Then they printed a bunch of money. Gold rocketed higher. It started rocketing higher in mid to late 2018. That's where I think we're at right now. Mid to late 2018 would be a similar liquidity cycle type move. Then we'll go and gold will, I think, appreciate. We'll get some money printing, which we're already getting some. Maybe they really turn on the spigot. I don't know. Gold generally takes off and accounts for that money that's being created, that monetary inflation. And then it'll transfer its way through oil, uranium, and all these other commodities that we all follow. The Kobayashi letter says bank bailouts were a one-time event. The pandemic, one-time event. $4 trillion in stimulus, another one-time event. 0% interest rates, one-time event. The collapse of SVB, one-time event. It says at some point that excuse is worthless. We're at that point. We're at that point. Paulo Macro, he's talking about copper here. So let's talk about copper. It says revisiting copper inventory for you guys after a 7 million ton hiatus. Don't be fooled by the sudden surge in inventory earlier this year. The draws of late have been wild. The drawdowns of copper have been wild. He says maybe the world will wake up in copper after all. Updated seasonality charts for global on-exchange copper inventory. 5, 10, and 15-year look back, left to right. 15-year lows here. But it's worse because global consumption was 23.4 million tons is 2016, 20 million in 2011, and 17.4 in 2006. So that's the no. So when this copper inventory declines, keep in mind that this is a less percentage of copper production as we go downward. We are at very low, very critical levels of copper right now. So there's what it looks like. That's 01 to 2023. Yeah, that's what we've got. And there it is, blowing on out. So that is crazy how low copper inventories are in comparison to history. And it says, and don't forget global copper consumption was 20 million MMTPA in 2012 and 25 million in 2022. So the fact that we are at a fresh 10-year low means on a stock to flow basis, we are at catastrophically low inventory levels. There's literally no room for error. And we talked about copper and how the inventory levels are very low right now. Ronnie says, those who expect inflation to fall rapidly in the coming year may well be correct, but history suggests that's a best quintile outcome. Few acknowledge the worst quintile possibility, in which inflation remains elevated for a decade. Thought that was interesting. So here's Tavi. What he says is low unemployment rates are up a few blah, 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 skating. A larger issue in the labor market today. The recent strength in employment data has almost entirely been driven by unskilled jobs. In fact, the employment population ratio among people with less than high school diplomas has recently surged to all-time highs. That is completely diverging from the same metric for workers with bachelor degrees and higher. Even though we have nearly 2 job openings for each unemployed person, most of those jobs available are not high-paying jobs. I actually think artificial intelligence is going to knock out a lot of the skilled labor. The unskilled labor, where people are moving things physically or putting things together physically, I think we're going to still need those jobs. I don't think AIs can really replace those, but I think AI could easily replace a buyer who looks in a system, calls a company and buys something. They could do that all automatically. So I think there's a lot more opportunity for AI to disrupt the people who actually have college degrees than people who don't, because I don't think AI can replace skill, I'll say labor that's putting things together. A lot of the designs out there are designed where people need to put it together. It's not designed for automation. Automation requires very tight tolerances. It requires things to fit together very repeatably. And a lot of the designs in the world are not that well designed for automation. So we have to have people build a lot of things like in aerospace. So I don't think AI can take that over, but they could easily take over project management, ordering parts, inventory management and release. It could replace all those jobs quite easily, I think. USD, this is oil. So if the green support does not hold, we could see $40 to $45 oil later this year, early 2024. What he's looking at is he's taking this, he's hitting the tops here, coming on down, and could we get a back test all the way down to $43 or something like that? It's possible. Now, if you look at logarithmic, this is on a logarithmic chart, and you hit the tops through here, 1, 2, 3, and come through this, and we basically tagged it this most recent time, which means we could easily start a move higher from where we are today, looking at logarithmic. Non-logarithmic means we could have some downside after this support area. Which one's right? I don't know. That's why you need to have a thesis, and you need to have a long enough a longer term outlook, and say, you know what, I'm going to ride through this no matter what. That's my outlook for oil and the oil holdings that I have. But that's not my entire portfolio. I have other things that I think will go up in the meantime to offset that if it were to pull back. No one knows the immediate near term. I know a lot of people, they think they know everything. They think that they can figure out the movements and time the markets in the short term. I don't think anyone's successfully done that with a very high track record. You can make educated guesses, but a lot of people, what happens is they get stopped out or something happens when it goes against them. So they have a small loss and they live for another day. Investors need more emotional strength, and they ride through all the volatility. So it's of my opinion that although oil could go down in a short term, problems in the market, which is very well possible, and it could be credit problems or something like that, or banking problems, and financial demand for oil could go down. So I understand both arguments here. The Hedgeless Horseman, he says, investing in one of extremely few human endeavors where inactivity typically produces better results. In most other things, more action equals better output. Very counterintuitive to human nature. That investing is typically better where you have inactivity, where you're not doing a lot of moving around. You have to sit there and do nothing. Here's silver on a quarterly basis, still very early. We've got a downtrend line, and we're starting to break that to the upside. Looks incredibly bullish to me for silver. I did release a midweek update. I know I was one day late on that. Sorry to everyone. Shabam says 2018 to 2020, Permian ramps up production at an incredible rate and building the drilled uncompleted inventory. In 2020 to 2022, Permian growing production at slower pace and heavily drawing on those drilled and uncompleted wells. In mid-2022 to today, Permian production flatlining and no excess ducts left, and well productivity declining. So this is the Duke inventory. We came up and then we're sucking those all back down. And this is our production coming on up. And you can see that we are, I mean, it's still coming on up, but we're waiting for that to kind of roll over. At least that's what I think a lot of us are, based off of the DUC wells that we're drawing on. Here's Nat Gas, and I really do like this chart. He puts a long-term trend here. And is this a breakout retest move and then a big launch to the upside? That's what I think will happen. I'm not saying it's going to be immediate, like it's going to happen immediately. But I do think on a larger, bigger, longer-term view that we could potentially rocket on up over the years. But that's my take on it, and it's a beautiful looking chart. It says the consensus on oil is constantly repeated on Twitter, usually by bearish anonymous accounts, ultra negative sentiment, totally disconnected from fundamentals. Please take a few minutes and look at my latest oil market update for the database perspective. It says, unfortunately, global oil demand is looking down. So the demand factor is more important than the supply hopium that the OPEC Plus et al. Is attempting to engineer. There's a big debate between the fundamental guys and the chart technical guys going on right now in oil. Demand versus supply. Who's going to win? We'll find out. We'll find out here in the next few months. This chart shows really how undervalued copper is and how overvalued the NASDAQ is. The ratio is back to almost the same level as the top of the dot-com bubble. It has clear red positive divergence, and when second inflationary global wave starts, this chart will start to move. This will be a big old move. We can see that this is a double bottom, booty bottom 1, booty bottom 2, and then you can draw a line across where the neckline is, and this will eventually work its way up and then eventually move all the way up here over the years. So copper most likely will outperform the NASDAQ over the next 10, 15 years. We are very short copper, guys. We also have a very similar chart. If you know this chart, it's the same chart down here for gold and silver miners versus U.S. equities. Double bottom. This guy has a little bit more hits down here, but it's really one big chart going across. We get a lead in, one bottom, two bottom, and then we're going to break and work our way up over the years. For that's gold and silver mining companies versus U.S. equities. Huge gold and silver mining bull at this time, especially if we can break out against gold, the commodity itself. So the U.S. government not only sold its oil reserves, but it also decided to sell its sour crude rather than sweet. To be clear, the current U.S. refinery infrastructure requires sour crude to operate. This is the whole reason why, despite the U.S. being the largest oil producer in the world today, it still needs to import sour crude. Even if there were a logical explanation to draw its strategic oil reserves, why on earth would the government sell the most critical portion of it? If you know of a legitimate reason, I'm all ears. Otherwise, this might have been one of the dumbest energy policy decisions ever. And this is our strategic petroleum reserve of sour crude inventory, and it's just all the way down here at very low levels. So good job, Tavi. Keep it going. That's where I'm going to end it, guys. That's what I've got for today. So, to sum things up, gold, silver, copper, oil, uranium, it all looks good. It all looks good. Could we get a downdraft in the short term where there's a problem? Yes, we could. Yes, we could. And no, we have not started that big third wave yet. We're still waiting for that liquidity to get worked through the system. Maybe they're going to print more money. Maybe they're going to buy and put more stuff on their balance sheet, the Fed balance sheet. We'll see. We'll see what happens. But that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Check it out. Become a platinum member. Love to have you in the community. And again, we have a 5 p.m. Mountain Standard Time Sunday session. I'll see you there. And that's all I've got. We'll catch you next time. It's Finding Value.